We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, Portfolio Manager at Crescat Capital. How are you today, Tavi? Thanks for joining me.
Thanks for having me, Tom. Looking forward to this conversation.
Absolutely. You know, I feel like a broken record saying there's never a shortage of things to talk about. And like we were saying before we hit record here, it hasn't, really been that long since the last time we spoke, but yet it feels like everything has changed again. So why don't we start with a little bit of what has been a continuation of a theme that we saw start to play out earlier this year. We saw 3 banks fail starting in March, and there is new turmoil in the banking sector this week. So with the 4 recent bank failures now equating to more assets than in 2008 and 2009, when over 150 banks went out of business, does this speak more to the amount of liquidity in the system versus the changes, let's say, in the banking sector since the great financial crisis?
Well, I like to say this is somewhat different in '08 because this is an interest rate risk that we haven't really seen in a long time in terms of the collateral price of most of the treasury instruments that have been under pressure, given the fact of interest rates rising, which is something, again, that is, we've seen this in the 70s and the 40s, even in the 1910s, but not recently. And so it's, I don't think anybody really knew what were the unintended consequences of when you have 60-40 portfolios declining as much as they did back in 2022. And in my view, we're in the middle of a lot of big macro trends unleashing. We started with this great rotation from growth to value. Financial conditions began to really tighten up recently with interest rates rising in 2022, which caused the collapse of a lot of things, particularly technology businesses. And then since the beginning of the year, if you look at financial conditions, they have eased up, believe it or not. And at the same time, the 10-year yield has also eased up a little bit, meaning it declined a bit. And those 2 factors have played an important role into, in my view, fitting this bear market rally that we've had so far. The bigger question for investors is if this is really a bear market rally, or maybe just maybe we're in the mid part of a cycle. I don't believe that that's the case at all. I think in order for you to see the bottom of equity markets, you need to see valuations being historically undervalued, and we're nowhere close to that. We're in the middle of assets being repriced by the fact that particularly discount rates being higher over time. And cost of debt is structurally higher. A lot of people are seeing this as perhaps being cyclical, and I don't think it's cyclical at all. I think the cost of debt itself will start to really squeeze the margins of companies. And this is something we haven't seen yet. We've seen prices sort of being under pressure of some assets, but earnings are yet at pretty high levels. And I think we're at a critical juncture for most corporations in terms of their earnings being squeezed by wages and salaries growth, by the cost of debt itself, by deglobalization, by the cost of materials depending on your business, service costs, and so forth. All those things are playing a role into squeezing the margins of companies. And so I don't know. I think a lot of people have this belief that things have been resolved. And I'm not sure that's the case at all. The banks are a good example of that. They're a big part of this collateral risk that we have. But the mismarking of balance sheets is not just a problem with the banking institutions. It's also a problem with private equity companies that have been mismarking their own technology startup investments that don't reflect the declining prices of overall markets that we've seen recently. What about commercial real estate companies? Or companies that invest in commercial real estate? What about junk bonds themselves? Why do we have VIX trading sub 20 when we have all these issues unfolding? Mm-hmm. So I think there's a lot of opportunities here, opportunities for credit spreads to blow out. I think there is volatility in terms of equity markets is way too cheap. And the prices of those assets are just not in line with the risk of fundamentals contracting moving forward. And I'm referring to mostly growth related stocks or long duration assets. Treasury markets are right at the center of most of the issues. So all that is in my mind. I think it's all, we've had very unusual 3 months here relative to this big trend that is, in my view, underway. And we're probably going to go back to the big trend, which means equity markets will be under pressure. Gold is probably going to go back to being this defensive asset that might capture some of the inflows from investors in central banks and large institutions. Commodities under allocated still will also benefit from this. It's really that commodities to equity ratio being so depressed that are poised to move a lot higher.
Mm-hmm. Wow, Tavi, there's so much to pick up on there and to tease out. But, maybe let's stick with that larger theme right now of what the consequences of these, the rising rates and obviously the varied lags that affects the market with. The last time we spoke, we talked about the risk of this commercial debt, as you were talking about, and how that starts to affect these large corporations that need to refinance that debt and how that starts to affect their balance sheets. So, from that point, like, I think you explained that very well, but, you made the other really good point that this probably starts to really affect the real estate market, the commercial real estate market as well. So, how many of these downstream effects do we have to consider that are a consequence of just rising rates by themselves?
Well, it's a good question because everything is tied to interest rates. And I think when we go back to what we learn in business schools is we learn about the interest rate risk, we learn about the inflation risk, and we learn about default risk, particularly when you're investing in the bond market. What we don't learn about is the issuance risk or the supply risk. Mm-hmm. And that's precisely what's going on in the treasury market. We've had cash operations from the treasury balance being very low currently. And every time we've had that balance being as low as it is currently, it coincides with other periods of the debt ceiling problem. And it's not like 2011, again, in my opinion, where necessarily the default risk should be the biggest thing in everyone's minds. While we may see a technical default, who knows? At the end of the day, they will reach an agreement. It is to the benefit of the two parties to at some point have an agreement and move on, extending the debt limit. Like it or not like it, I don't think it goes back to the trifecta of macro imbalances. The US is facing the 1940s debt problem, the 1970s inflation problem, and the 1990s valuation problem of assets. They don't have an option. They have to extend the debt limit. Now, the big question is how do markets absorb, call it $1.2 trillion of treasury issuances in the following months? In my view, that has been one of the big reasons why we've had yields being pressured higher in 2022 and 2021. Not a lot of people are talking about that, but the level of issuances we've had over the years here, over the last 2 years, has been tremendous. And recently, obviously, because of the debt ceiling, we haven't seen any. So the government will have to catch up with those issuances. There's more people starting to talk about that. And guess what? The deficit relative to GDP is back to 7%. And so we have the most aggressive fiscal policy relative to how low unemployment rate is. If you think about this, it's almost like, well, we have conflicting policies. The Fed is raising rates, and then every time there's a liquidity gap, they then raise their balance sheet assets again. And at the same time, you have the government spending money right and left on inequality issues, on social programs, on green revolution, on infrastructure, because we can't rely on China and other countries anymore, on military spending. This this fiscal agenda has never been so big. And then you have the other side of it, which is today accounted by about 50% of the fiscal deficit relative to GDP, accounts for interest payment. And that is only going to grow from here if the idea that I'm thinking occurs, which is rates being pressure higher on the 10-year and across the entire yields here of the Treasury market. And so I'm very concerned about this because it's at the center of a lot of issues. It's at the center of the 60-40 portfolios. You got to ask yourself, where should junk bonds be trading if that's the case? If anybody looks at credit spreads trading at sub or about 2% today, which is just the difference between Treasury yields versus corporate bond yields, that is not right. That's something, it has to be reflecting the level of risk that everyone is facing here. And remember, when you go back to analyzing the bond market itself, there is certainly the inflation risk, the default risk, and the interest rate risk on top of the supply risk. So we've got all those things going for it. And it amazes me that there is still an approach being driven by investors today by looking at the situation and thinking that market correlations will look like how they were the last 10, 15 years. I could not disagree more with that thought, meaning I don't think treasuries, this whole idea that treasuries rally with gold, that was not the case in the 70s. So at that time, you've had a total divergence between the two instruments, given the fact that central banks are buying gold in order to improve the quality of their international reserves and not buying treasuries. So you've had the inflation risk being one thing that was impacting treasury yields to rise. You also had the interest rate risk. Default risk wasn't as high as it is today, given the debt levels. And so, but still you've had a major divergence between treasuries and gold itself. And some people may say, well, it's real rates that matter. We'll go back to the 70s. We're in a different macro regime that we've had over the last, 5 to 10 years. And gold has started to do that in the prior year, where you've had most bonds collapsing over the last, call it, 20 months or so. And gold held up its level very well. Look at what happened with TIPS, or Treasury inflation protected securities. Those also collapsed and gold held its ground very well. And so there is clearly a beginning of a change in correlations and being fueled by central banks buying gold and selling treasuries in a big way. And that is, a big theme happening that has lags to go because central banks don't own enough gold in their balance sheets relative to history. I've done a research on this, and the percentage of gold relative to international reserves still is 20%. Back in the 70s was over 70%. And so if we got to go back to those levels, just doubling that amount, it would unleash at least $2 to $3 trillion into the gold space. And then you can extrapolate on that, because what central banks do will ultimately be what institutions do, pension funds and so forth. They all kind of move along the same direction in a certain way. If they think that gold is the quality asset to own to improve the quality of that balance sheet, obviously that's going to be followed the same way along with other larger institutions that face similar issues. And so that is, a big situation, a big transition of assets that we're, I think, experiencing at the moment.
Mm-hmm. Tavi, when we think about that 70% number that you just said, was that the right number for central banks that were holding in the 70s?
Well, it was right at the end of the 70s, because gold as a percentage of international reserves, and we got to go back to why do they own gold and assets in general? Well, central bank will have a monetary system, and they have to, just like any company, have assets to back the stability of the currency system. And back in the days, gold was what drove that level of stability and the level of credibility. But since we've seen that peak at about 70% of gold relative to their balance sheet assets, since the 80s or so, we've had a secular decline on that ratio itself, where this most credible central banks, believe it or not, in the world were the ones that actually held a significant amount of treasuries, U.S. treasuries. And, that has, I would say, created a lot of different macro trends on the back of that itself. I mean, just think about the technology sector benefiting from lower cost of capital, or the entire market. The level of return expectations from new investors in markets is absolutely insane with what we've seen throughout history. This idea that we'll continue to see the same level of returns on risky assets in the next 5 to 10 years is very unrealistic. And so it starts with the extrapolation of fundamentals. We've had in 2010s, not to digress in a different topic, but in 2010s, we've had the most successful, most robust decade in terms of corporate growth, corporate earnings growth. And the prior times we've seen this is the 1920s and the 1990s. Both of those decades preceded large declines in contraction of earnings in a subsequent decade, which was the 1930s. And then the 2000s, which we had the tech bust and the global financial crisis. And back then was the Great Depression. And it wasn't, it's not like technology and breakthroughs and technological advancements really saved the market from going through its own long-term cycle. We've had the invention of one very important thing back in the roaring 20s, which was the television. Think about all the changes in terms of communication and, even commercials and movies, and a whole industry that created an entire different environment back then, or the internet in the 90s as well. Those are all incredible times. I'm just trying to paint a picture of this fallacy, in my opinion, of the AI and other things will save the market from having its normal long-term cycle of earnings, which is up. Robust earnings always tend to precede very negative periods of corporate fundamentals in general. And I think we're at that critical juncture again. I think wages and salaries will play a role in a big way. If you look at just how much companies have spent on wages and salaries relative to their profits over the last years, were historical lows in that trend itself. Companies are going to have to pay or share more of their pie of their profits with their workers. And that is just going to be part of the big picture here. And I don't think a lot of companies today are being valued according to those changes. And I think, a lot of things will change moving forward. And it's just hard to believe that gold itself won't perform very well in this environment. And if you think that way, as an investor, you have to, again, extrapolate that thesis into what are the most asymmetric ways of expressing that view. Mm-hmm. Now, I certainly have a lot of opinions on that as well.
Well, Tavi, the reason I wanted to bring up that, let's say that stat that you said about in the 70s, global central banks having something like 70% of their assets backed with gold, and now that's, let's say, less than 20 or somewhere around 20. That really makes me think about let's say that cycle that what gold was replaced with. As you say, maybe it was a good amount of US treasuries. And again, extrapolating that out from now, if we see a major issuance of treasuries continue, if that starts to, undermine the credibility and the soundness of those treasuries, and that is part of that cyclical return driver as well to gold. Is that fair to say?
I think so. However, I don't think it's particular to the treasury market. I think is, you want to look at a scary chart, look at what's going on with the ECB balance sheet. And since November or so, their assets are down about $1.1 trillion in euro terms, which is a very significant amount of withdrawal of liquidity in the markets. And it's really almost like we're waiting for something else to break here until they have to change their course. And why am I saying this? Because if you look at the performance of foreign bonds or international bonds outside of here of the US, you're going to see clearly that they have not performed as well. We have not seen the same level of appreciation at the beginning of the year, which caused financial conditions to ease up a little bit since the beginning of the year, really helping to fuel this bear market rally that we've had recently. And one of the big reasons for that is because they're still issuing their own debt instruments. And the problem is that the demand side of debt instruments in general has probably reached a peak. And I don't think we're going to see the same degree and magnitude of buyers that we've had over the years in that part of the market. And that's not the end of the fixed income market at all. I'm not claiming that at all. I'm just saying the portfolios in the future will look very different than they look now. If you just think about the 60-40 portfolios and how that composition will shift towards just being more balanced and having more commodities and gold and other things, it will certainly be a big trend as well that will cause a lot of influx of capital into different industries. So yes, and honestly, if you just look at the amount of this fiscal agenda that we're seeing, the defense spending, for instance, is right now about 3% of GDP. Back in the days, used to be 60s, which wasn't even a period of a World War II or anything like that. Was somewhere close to 9% of GDP. What if we go back to just double the amount that we have currently to 6%? How are we going to fund this construction boom that we need to see in order to have the green revolution and the manufacturing that is necessary to avoid this reliance on China? That's going to create a huge amount of fiscal spending as well. And I always go back to the point of this irresponsible fiscal spending seems to be not aligned with the idea of inflation being secular, meaning I think policymakers just have been so complacent over the years that have forgotten about a clear correlation between government spending and inflation. And I think we're going to have to learn a lesson here in the following years. And now you're seeing some commodities beginning to weaken given the banking issues and other problems that have emerged in markets. And if you look at the oil market specifically, just as an example, we're not fixing the supply issue at all. The supply market of oil and energy in general remains very tight. And the capital spending of the industry overall remains very low. And if anything, all we're seeing is that strategic petroleum reserves, which were being sold in a large way months ago, guess what? Have begun to be sold again right now. And so all that is adding to the pressure of those things. And there's nothing strategic about this. This is just, I think, a major mistake by the government by selling those strategic reserves. There's nothing strategic about this. And so
maybe just strategic from an optics point for right now, right?
Very short-term driven. And I'm not sure, this is what we should be doing when we are seeing the clear signs of deglobalization as we're seeing right now. This level of reliance in other places. I mean, think about, just the level of sour crude that we've been selling, because we have sour crude and sweet crude in the US, strategic petroleum reserves. Majority of the petroleum that have been sold so far are the ones that we actually need to import, because those come from Saudi Arabia and other places because of the infrastructure. The refinery infrastructure in the U.S. requires a mix of those oil products, and so it's very scary to see what's happening, because I don't think this is a long-term solution to the problem, and it almost feels like we're putting ourselves into a corner that will be very costly in the near future. I mean, if the Fed is, the problem right now is a liquidity problem. Everyone's worried about liquidity because of what's happening in the banks. But in the difference between today and '08 is the fact that nobody knew what the Fed was going to do back then. There was some people maybe, considering that the Fed could step in. No one really knew the Fed would step in to the degree that they did. And then in 2020, they stepped into a degree that we really haven't seen throughout history. What do you think it's going to happen if more banks begin to fail, or commercial real estate begins to fail, or private equities begin to fail? Well, look, they just saved venture capital funds that had money deposited in some of the failing banks. Why would they not help other parts of the economy that could be in trouble very soon, given of what's unfolding here? Mm-hmm. So it almost feels like liquidity won't be a problem. It may trigger issues in the short term, but will be immediately met by intervention by the Fed or the government. Mm-hmm. And if that's the case, what does it mean to markets? What does it mean to something that has finite supply, like gold or like silver or copper? Those things have real value here. And I think the businesses that are involved with those underlying securities will do very well, given the fact that we're going to need those securities to not survive, it's not the right word, but to really navigate the space in markets over the next decade or so.
Mm-hmm. Yeah, I couldn't agree more, Tavi. And, it brings back the point that we need to actually be looking at this from a bigger picture standpoint, not necessarily just, what serves us tomorrow. But, at Crescat, you guys have several themes that you have identified that you're investing for. And on that theme of energy shortage is one of those pieces that you guys are deliberately trying to invest for. So are many of the shortages that you foresee, self-imposed, like selling off of the SPR at this point? Or is it, short-sighted energy policies versus a more forceful shortage scenario like peak oil that you see at this point?
Well, it's an interesting question, because when commodities become geopolitically strategic, like oil, for instance, and you rely on that commodity to function operationally speaking, it becomes almost a survival need to make sure you have enough of it. And I'm not sure we do. Another fallacy is to say that the US is fully independent when it comes to energy. It's not. It's because of the refinery infrastructure doesn't allow the US to just use solely its own producing of oil, specifically. And, maybe it's self-imposing, this green revolution. Maybe things are going to have to slow down because we don't have the necessary materials to make the transition more appropriately. But I don't think we can fight the trends of deglobalization. And I'm not sure this is really self-imposed. If you start seeing problems, which they've been increasing over the years, back in 2015, 2016, remember, this was really coming. Trump started to question a lot of the issues with China. And this was not a bipartisan view. Now, US and China conflict is very much a view that most US citizens would agree with. And this is starting to unfold in a very scary, but also I'm not sure is really controllable either. It's just part of, two powers that have, reached a apex, I guess, in the US case, and beginning to see another emerging one to compete with the US economy. But I'm not too worried about that side of it. I'm worried about the consequences of that, specifically in terms of logistics, in terms of the need for countries to reshore and their manufacturing plants. And I go back to what happened in the early 2000s with China entering the WTO, which is a good example. And that itself drove what was one of the best bull markets for commodities that we've seen in history. And gold did very well, copper did very well, every commodity did very well, even agricultural commodities, because they're all linked. They are all in the same boat, and they're all driven by a cascade effect. When one commodity goes up, others go the same direction. Very rarely you will see gold making new highs and copper not taking too long to follow along. So while people call that, copper, Dr. Copper, a cyclical commodity, if you chart the two over the last 20 years, you're going to see they're almost the same chart. The same goes for agricultural commodities. My point being is that one country in the early 2000s that wanted to become the manufacturing plant of the global economy drove an entire bull market for commodities. Imagine if we have all G7 economies doing the same today. What would that do to that market? So, and knowing that we just spend, 1 or 2 decades of a chronic period of underinvestments in natural resource industries, and you can see that very clearly just by looking at the capex trends of most of those companies. So, and the natural challenging period of finding discoveries, just because geologically things are becoming harder to find. It just, again, it doesn't mean the end of the world, but it's just that difficulty level is going to add to the constraints that we have in terms of supply. But I'm very excited about the opportunity in the space of tangible assets, particularly commodities, because especially the gold space, for instance, just use that as an example. I've never seen a time when gold prices are about to break to new levels. And if you think about it, it's the only macro asset today in the world that is about to reach record levels. Not Bitcoin, not the US equity market, not treasuries, just gold. And what is interesting about this is that the businesses that are related to the metal, especially exploration and development companies, they are at historically depressed valuations. And so I've never seen such a large divergence between the two. And the major companies that were supposed to be taking advantage of this, producing gold, making money with gold prices where they are, even on a revenue basis, because I know other people will say, well, have you not seen the cost of producing things have risen significantly? Just look at the top line itself, the revenues. They've not followed at all gold prices. And which means gold companies, even the larger companies specifically, have lacked vision. And they are not focused on production. They're not focused on expansion of their resources. And, to me, this is setting the stage for, perversely, one of the best periods to invest in the gold space, especially if you're investing in high quality assets that really the overall market is just not focused at all in that part of the market. I mean, it just doesn't even understand the news that those companies put out. It's just a completely inefficient market. So yeah, there are a lot of issues going on unfolding in the macro environment, but the opportunity here, I think it's one of the best that I've seen in my career.
Mm-hmm. Tavi, that's interesting, the point that you make about producers here. And, going through doing research for today, I see that you guys hold far more explorers than you do producers or developers. Is that part of the reason that you're comfortable with holding explorers for this cycle rather than producers?
Well, I think the early stages of the industry are much more attractive than the later stages. I think that the major companies, as I said, lack vision, but not only that, they are in the business of, aging assets with deteriorating quality of their reserves, and no investments whatsoever in discoveries. And so we went through this in the last cycle here, which was a very difficult cycle for gold investors. And it is very clear that companies are very concerned about spending capital in general. Mm-hmm. But this is fighting the last war. Miners were capital bleeders in the last decades, but not today. they are extremely conservative today, almost to the point, not almost to the point, they are at the point that this is becoming concerning now because they're returning more capital to shareholders than investing in their own businesses, meaning they have more buybacks and dividends than what they do on CapEx. So it's creating an environment. And if you just look at revenues, as I said earlier, of the overall industry, which is mostly driven by the majors, relative to gold prices, there is a huge divergence between the two. Newmont just put results recently, and that's what it shows. Ask any Newmont of executive if they've been buying their stock. We haven't seen any buying from Newmont over the last 5 to 7 years. Mm-hmm. It's almost like they don't even believe in their own company. So, it's a little scary what's going on, but it's a good opportunity because it's setting the stage that if you see gold prices rising to levels that we think it will, given this, the degree of macro imbalances that we have, and I have very high conviction on that call. What do we think it's going to happen here? I think there's going to be new Newmonts and new Barricks emerging because it's creating or setting the stage again for someone to be creative, and we need that. And maybe it's you guys are involved with Newfound Gold. Maybe it's that. Maybe it's Crescat. Who knows? I don't know. But I think we're going to see new Newmonts and new Barricks being formed in this gold cycle because we need that to happen. And they are not doing anything for that to be for the problems that we have in the industry to be fixed. Mm-hmm. So going back to your question, why exploration? Because I've never seen a time when gold prices are at the level that they are currently, and you have a property, let's say, or a project that is, call it really high probability, and I don't want to number what the probability is, but let's just say it's a very high probability to have a major discovery. Company is cashed up, very good balance sheet, good team, and still trading at depressed levels. It makes zero sense. Either I am about to be very wrong about all this, or this is one of the most asymmetric opportunities I've seen in my career. Why? Most of the billionaires in this industry made their money in exploration, made their money into buying early stage projects that became major discoveries that then became a major company. And so, yes, we've been investing, just like the 90s when venture capitalists and most of the private equity funds deploy most of their capital into, I would say, startups in the technology space. And you had, hundreds of companies that they held in their portfolios, and only one unicorn would make up for all the losses in the other companies. This is essentially what we're trying to replicate in the mining space. I'm not here to say this is an easy strategy. It's a very difficult strategy, but I get really excited when this is a very contrarian part of the market where no one is really paying attention to. So the level of inefficiencies creates a lot of opportunities. And so I think there's a way to be very creative here and really exploit a part of the market that I think has never been so depressed, given how fundamentals of the overall macro of this industry continue to improve and might drastically improve over the next, call it 3 to 5 years. Mm-hmm. And so I'm really excited. But we've been also investing in developers. I don't want to put those guys aside because they're also very depressed. Some of them for reasons because their CapEx have gone up massively in order to put those projects into production. But we recently bought the 7th largest silver mine in the world in Bolivia. And why? Because it was cheap. And we believe in silver. We believe in gold. It's the 3rd largest zinc mine in the world. It has the potential to become the largest silver mine in the world because it's got a great potential for exploration, and that's our niche. And it was the main reason why we've made the initial investment. And look, I think that's what it takes is to, in such a depressed market, you want to be aggressive while everyone is just being fearful. And so I guess that's somewhat of a sentence from Warren Buffett. But yes, I'm really excited about this, Tom. I think this is going to be a great opportunity here.
Tavi, as we talk about your guys' position within, let's say, the gold and silver miners, producers, developers, explorers, how do you think about, deploying capital? Is there a condition where you would, go all in completely, or are you at a point where you're comfortable with the positions that you hold no matter what, let's say, the market does? Is there a particular price or signal from the market that you would want to see where you would even invest more than you guys already have?
Hmm. I don't think I'm never fully happy. I'm always looking for more allocation. And I think there's no shortage of opportunities. If I have more capital, I'll probably be doing more. Certainly we've built a really large portfolio of ideas and have become large shareholders of small companies that could potentially become major companies one day. I think it's important to have optionality. The optionality comes from, since everything is so priced for failure right now in this industry, you're able to find there's not really a big difference between high quality assets versus poor quality assets. And so you're capable of building a diversified portfolio, geographically speaking, too, because obviously we've got a lot of things in Canada and US and Brazil and Bolivia and Australia, and one investment in Africa. So we're very well diversified in different places. And I think everything has a price. This thing of I'm not going to invest in Bolivia. Bolivia is changing, for instance, is a place in South America that I'm from Brazil, so I've been lived in Brazil most of my life and understand somewhat well of the level of issues that we've had in that region. And I'm happy to be more bullish in this space because I think South America will play a big role into this deglobalization trends that we're seeing and will serve the world of developed economies the metals that they need and the minerals that they need in order to supply this green revolution, infrastructure developments, and lack of reliance in other parts of the world like Russia and China. And so, to me, the optionality of owning high quality assets, number one, diversified in terms of geographic jurisdiction in general, scalability is key. Meaning it's not just a high quality asset, but that can be scalable and become a company maker is one of the critical aspects of Crescat that we look for. How can we deliver value here? How can we unlock, some sort of value through our own activist approach? Meaning, is it something that we can help in terms of the exploration developments that they have, or is that something that we can change in terms of investors' base, or using our own network to really support those companies to perform better? I think there's a lot of ways to help from an activist approach. Can we help them with vision to acquire other projects, focus in different things? Those are all important parts of our role into the companies we invest. But at the end of the day, you can deliver a lot of value even in a bear market in this space. Our funds have been up even though gold prices were or miners have really suffered since the beginning of our funds, which was in 2020, middle part of 2020. And so, it's interesting that even, let's just say, Kirkland Lake did very well in the middle of a bear market. High quality assets, if you're able to unlock value of it, they can perform not being in a gold cycle. Mm-hmm. But ultimately, I do think we're in a gold cycle, and that alone can drive the entire industry much higher. And if that's the case, the level of performance that can be driven by a gold cycle that is a long-term one that I think we're entering in the space can be tremendous. And you guys know that as well at Palisades. And so I am really excited about the following years because it has been taking us over 2 to 3 years to really get to the level that we are in terms of the knowledge of the industry. Do I know everything about it? No, I'm still learning a lot. I still, I hope to learn a lot as well. I'm still chasing, the perfect allocation. I don't think I'm ever going to get there, but I'm certainly not sitting around while silver is still trading sub $30 an ounce and everyone is waiting for a breakout to buy silver. That's not what I'm doing. I'm trying to buy while it's depressed. And so, I think that's the mentality that it takes to hopefully be successful in the space. And that's certainly what I'm trying to accomplish.
Yeah, I think that's an excellent way to put it, Tavi. And I want to ask you one more, weird question before we wrap up here today. Again, going through some of your corporate presentation here for today's interview, why do you guys want exposure to zircon, and how have you gained that exposure?
Oh, this was just one investment that we had recently. Nothing. It was just a good project with good fundamentals in terms of the economics of the project itself. It's part of other exposures that we have that we like to have, like tin is another one, cobalt is another one, nickel is another one. Different than most institutional capital have been chasing lithium. We've been chasing things that we also believe are critical, but have not been, really almost like a contrarian view. I mean, it's nickel is going to be very important in the future, just like the other metals that I mentioned, and the projects are not being priced accordingly relative to lithium prices, even though they have recently collapsed here, and it makes sense given the level of popularity. But look, we're even getting involved even more recently with manganese. Now it's another one that it's just not very common to see good projects out there, and we're open-minded to those if the economics make sense. Or niche is definitely on precious metals and base metals. At least we like to think our niche is that. It's mostly because Quentin understands that very well from a geology perspective. And look, the prices of things are just so cheap right now, as you know, as well, too. The critical metals that fall into that category. And again, for people that try to understand the space, you're going to find that critical metals have different definitions depending on the country. And so, because every country will need certain metals and others will need others, and that is what changes the level of relevance in terms of being critical or not. But there's one thing I would like to say regarding our investment, because it's I think it speaks to the overall industry. I've done a research recently on the oil industry, because commodity markets, when they start to unfold, you start seeing parts of the commodity markets to unleash first. And I would say that the first one that we've had since 2021 has been the energy side. Energy side has done very well. Two of the best year performances we've had over the last 30 years, back to back, 2021 and 2022. And I wanted to understand which ones are the companies that did better in that and why. What are the factors that cause those companies to do well, so we can learn about it and apply that in the mining space. I think that's relative to the opportunity here. And what I found is that most of the energy companies that perform better, or a majority of them, by far, by 40 and 50% spreads of performance, were in the buckets of companies that were increasing capex, increasing production. And the companies that underperformed massively were the companies that actually were returning capital to shareholders in a big way through dividends and buybacks. Immediately, what I thought was, well, that maybe has to do with market caps. Maybe larger companies are, just paying more dividends and just don't have the same, degree of I guess, opportunity to return better than the smaller names and things like that. And I was wrong. It had nothing to do with that. It was just even smaller businesses that were paying high dividends and doing large buybacks were being penalized by the market. And those others were being rewarded by being aggressive at the right time of the cycle. Well, that's a lesson for the mining industry, because this is basically what we're seeing across all the major companies. And if you divide the top 5, the top 10 largest miners in the gold space today, CapEx is basically an ultra, call it, I don't know, if you adjust it for GDP, is at historically depressed levels. Now, if you look at the other side of it, so looking at the top 10, top 50 companies, top 10, now let's look at the bottom 40. The bottom 40, which are kind of mid-sized companies, you're seeing CapEx actually being much higher. And if you look at across those businesses, their performance in the last 1 to 2 years, they have not been penalized by being aggressive. And that's really interesting because we really haven't seen yet that, big macro tailwind driving gold companies in general. But once we do, I think the market is sending a very clear message that companies that are being aggressive, that are doing CapEx, that are actually focused on increasing or expanding their resources, increasing production, increasing growth really, are going to be the ones that are really going to benefit from this cycle and not the other way around. And so, this is an issue because most of the capital that has been, I guess the influx of capital we've had so far in this industry has mostly been coming to those big names. And a lot of institutions have realized that they are not really in the growth phase whatsoever. They haven't really been focused on improving their bottom lines and their fundamentals in general. Even top line growth has been dismal. And so I think there's a lot of learning from the energy space. And if that's the case, I want to be investing in the companies that are being aggressive, that are actually focused on having a vision to really expand the resources at a time when I think resources are going to be worth a lot more money than today.
Mm-hmm. Yeah, that's a great point and a great lesson to have studied and to bring over into a different industry that is, hopefully going to reward shareholders for being aggressive. And I appreciate getting to have the chat with you today, Tavi. I know you and I both have Fed meeting to get to here as we're recording this on the 3rd. So, of course, you're available at crescat.net and at Tavi Costa on Twitter. Tavi, thanks so much for your time today. Really appreciate it.
Thank you. It's always a pleasure talking to you. Thanks for having me.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.